Let me tell you, this isn't just some dry story about numbers on a spreadsheet. No, this is a high-stakes thriller. We're talking corporate raids, ghost companies, and a breathtakingly audacious plan that siphoned billions of dollars right out of Bangladesh's banking system. It all starts with this one single devastating number, negative 4.95%. By the end of 2024, that was the capital adequacy ratio for the entire Islamic banking sector in Bangladesh. Now, what does that mean? Think of it as a bank's financial cushion, its safety net against losses. The absolute legal minimum is supposed to be 10%. So, negative 4.95%, that's not just a red flag, it's a sign of a system in total, catastrophic collapse.
So you have to ask, how on earth does this happen? How does a whole banking sector, one that's supposed to be built on ethical principles, end up in a hole this deep? Well, the answer takes us right back to the beginning of what investigators are now calling one of the most sophisticated financial heists in modern history.
And it all kicked off not with a stock market crash or panicked customers lining up at the bank, but with a shocking corporate raid carried out before the sun even came up.
Picture this, January 2017. Military intelligence officers show up at the homes of the top executives of the country's biggest Islamic bank. A few hours later, those same executives are in a hotel being forced to sign their resignation papers. And by the end of that single day, a powerful, politically connected company called the Islamic Group had seized complete control. The stage was now set for a systematic plan.
Now, once they were in charge, the new controllers didn't just mismanage the bank. Oh no, they built a machine, an extraction machine, designed for one purpose and one purpose only, to pull billions of dollars out with terrifying efficiency.
And the very first step for this machine, total control. They had to completely dismantle the system of checks and balances from the inside out, the very rules designed to prevent this exact thing from happening.
And the scale of this takeover was just staggering. The law is crystal clear. No single person or company can own more than 10% of a bank's shares. But by using, get this, 24 different companies as fronts, the SLM Group secretly managed to get control of 82% of the bank. That kind of concentrated power basically gave them a blank check.
So, with control locked down, the extraction began. It was a three-step process, really simple in its audacity. First, they set up a web of 18 shell companies offshore. Ghost companies that only exist on paper. Second, they used their control of the bank to give these brand new companies enormous loans. We're talking nearly $80 million to a company that was just a few days old. And third, they used that whole network to funnel the money out.
So you might be wondering, where were the regulators in all this? Well, in a move that is just truly baffling, just as the red flags were popping up everywhere, Bangladesh's central bank pulled its official observer from the bank in 2020. They literally removed the last line of defense during the absolute peak of the looting.
All right, let's talk about the price tag for this operation, because the cost was staggering. This wasn't just a loss for shareholders. It was a body blow to public trust and the country's entire economy.
The grand total that was extracted comes out to 731 billion taka. Now, to give you a sense of that scale, that's nearly half of the bank's entire lending portfolio. An astonishing amount of money just drained from one institution.
The fallout was swift. As you'd expect, depositor confidence just evaporated. In January 2024 alone, people pulled huge sums of money out of these dedicated Islamic banks. But here's the fascinating part. The Islamic divisions of regular, conventional banks, they actually saw their deposits go up. This tells you it wasn't a crisis of faith in the idea of Islamic banking. It was a crisis of trust in these specific, corrupted institutions.
So, with the system teetering on the edge of collapse, the central bank has come up with a pretty controversial solution: a mega merger. The plan is to smash 5 of the most troubled Islamic banks together, creating what would become the country's biggest bank. But that raises a huge question. Can you really solve a problem of corruption and bad debt by just combining all the broken pieces into a bigger pile?
The challenge here is just immense. I mean, look at these numbers. Exim Bank, which is supposedly one of the stronger banks in this group, has a loan default rate of 28%, and that's already really high. But 3 of the others have default rates around an unbelievable 95%. It's pretty easy to see why any healthy bank would look at that and say, no way are we absorbing that catastrophe.
And make no mistake, this isn't just moving some names around on a corporate chart. This would require a massive public bailout of over $1 billion.
That's taxpayer money being pumped into institutions that failed because of deep, profound corruption, not because of a bad economy.
So to really understand how this happened, we have to look past the balance sheets. This wasn't just a failure of finance. At its very heart, this was a failure of politics.
The crisis was made possible by something experts call political capture. That's when powerful private interests with deep political connections can influence the state's decisions for their own benefit, basically neutralizing the regulators that are supposed to keep them in check.
And this powerful conclusion from Transparency International Bangladesh really says it all. They said it wasn't one bad apple. It was a systemic collusion between the bank owners, the regulators, and the government that created the perfect storm for this heist to happen.
But there is a potential path forward. An interim government has started to push for some really key reforms. Things like limiting how many family members can sit on a bank's board, banning politicians from serving on them at all, and most importantly, strengthening the central bank's independence from political pressure.
Ultimately, the choice is pretty clear. This crisis is a painful, critical lesson for emerging markets everywhere about the profound dangers of mixing political power with high finance. Whether Bangladesh can turn this disaster into a chance for genuine, lasting reform, well, that remains to be seen.